This week on Generating Alpha, I sat down with Ryan Tolkin, a transformative leader in the hedge fund industry and a key figure in the evolution of the global multi-strat model. As the Chief Executive Officer and Chief Investment Officer of Schonfeld Strategic Advisors, Ryan has been instrumental in the firm's evolution from a US-centric family office into a global multi-strategy powerhouse. He's known for spearheading the firm's transition to an RIA and leading its expansive international growth across Europe, the Middle East, and Asia. A former high school intern at Schonfeld, who later spent 5 years on the corporate credit trading desk at Goldman, Ryan rejoined the firm in 2013 and rapidly ascended the ranks, becoming chief investment officer at the age of 27. His leadership philosophy emphasizes empowering a vast network of highly skilled portfolio managers, driving innovation in quantitative investing, and successfully integrating new strategies like discretionary macro and fixed income. In our conversation, we spoke about his unique path from a young intern to the firm's leader, how Schoenfeld manages a large and diverse set of investment teams under a single platform, the importance of culture and collaboration in a high stakes trading environment, and his outlook on volatility and opportunity in today's global markets. If you enjoy this episode, please follow the podcast and rate it 5 stars out of Spotify, subscribe on YouTube, and share it to anyone who you think might find it valuable. I really enjoyed recording this with Ryan, and I hope you guys enjoyed listening. Thank you.
Awesome. Happy to be here, Amir. Let's do it.
Well, I want to start where I always do, at the beginning. So, would love to start with a little bit of background about your early childhood and upbringing, and tell me a little bit about the environment you grew up in. What was it like, and what were your early interests?
Sure. So I grew up about 25 miles east of New York City in a town called Jericho on Long Island. I am the oldest of three boys in 3 years. So we were all in high school at the same time, 12th grade, 10th grade, and ninth grade. And so I would say my house was very, very competitive. As my mom would describe it, she spent the majority of her day breaking up different arguments around who was winning different sports games, or perhaps other things as it relates to social interactions as we grew up. But it was a dynamic environment. It was one in which I would say a combination of academics and sports were sort of always at the center of our discussions. My dad was in the travel business, so part of the perks of him being in the travel business was we had an opportunity, to experience a lot of different cultures. And as he was hosting conferences for travel agents around the world, get to experience and go to a bunch of different destinations, which I think gave me an opportunity to fully appreciate different people from different backgrounds, different cultures. Travel the world at a relatively young age, and really kind of understand that the bubble that to some extent was the sort of the 25-mile area surrounding New York City in all four directions was not necessarily what the rest of the world looked like or felt like. And so I think that was a unique experience at a relatively young age, to help shape who I am.
And around that time, you got your first exposure to investing, if I'm correct, in a stock picking game in Newsday. Tell me about that experience and how it evolved into you're getting your Series 7 in high school, and then ultimately trading securities at Schoenfeld as a high schooler.
Sure. Yep. So Newsday, which was the local paper on Long Island, ran a stock picking competition, I think for middle schoolers, at the time. And so my first exposure to stock picking really came from the Newsday stock picking competition. And the reason why I got hooked on it was Newsday had a great local sports section. And so I spent the early part of my childhood where I was really fascinated in sports, and most importantly, not just the actual watching of sports, but the analytics and statistics around what made teams good, what made individual players on teams good, how did people perform, in one game or throughout the course of the season, how was that predictive of how they would do, in the future. And so, just being exposed to Newsday analytics and sports ultimately, gave me this exposure to the Newsday stock picking competition. and then I became a bit obsessed. At that point, the newspapers were publishing, how stocks performed, every day. There was no sort of Bloomberg terminal or kind of internet to go on, at that point to sort of, be able to get any stock pick, in real time. And so you look in the paper and you look and they would publish how the stocks did, each day, and prices at that point were published, in fractions, not decimals. And so you'd see Apple stock is up by a quarter of a point today, and you'd really on a daily basis get to track how your individual portfolio was doing. And so that was my first exposure to stock picking. In my mind, it was like very similar to the way I thought about sports analytics, in that there was a daily report card, there was a scoreboard. You could easily see the scoreboard. You knew how you were doing, and you knew how you were doing relative to the competition. And so I think that that was fascinating. It sort of gave me a metaphor of, how the stock market in some ways, tested similar skill sets, and characteristics to being in the sports analytic field. And that sort of drove an interest in it. And, from there, at Jericho High School, we had an opportunity to do a work study program, in lieu of taking certain classes. And so there was a firm, that had a significant presence, in Jericho, which was called Schonfeld Securities at the time. It was a short-term trading oriented firm run by Stephen Schonfeld. And, I applied to do a work study program, at Schonfeld, where really the job was quite similar to the way in which I thought about sports analytics, which was I would develop report cards for each of the different traders around things that they did well, things that they did less well, and then I would try to provide the traders insights and analytics on ways in which they could improve their performance. And that led to me developing certain insights as it relates to patterns, pattern recognition, amongst this group of traders, which then, I had an opportunity to present and share with Stephen Schonfeld, or the namesake, of the organization, who was obviously responsible, for developing and providing capital to this group of traders. He was interested in what I presented. And, from there, he gave me an opportunity to ultimately clerk for some of those traders. And eventually, as you just suggested, take my Series 7 and actually begin to start to trade a portfolio. And so I did that once I got into college. I had the opportunity to have a little bit more free time in my life. And so I took the Series 7 training class as a senior in high school, eventually passed the Series 7, and then got the opportunity to trade, as part of the Schonfeld Securities trading team, throughout my college career, on and off at several different points. And that really obviously drove meaningful interest in asset selection, stock selection, and short-term trading.
And you were trading at Schonfeld during college when you were at Duke. And then before you returned to Schonfeld, you became a credit trader at Goldman Sachs for a couple of years. I'm very interested in, you rose through the ranks of Schonfeld relatively fast. You became CIO at age 27. What do you think that experience at Goldman, or the experience between, gave you that an insight in that you wouldn't otherwise have?
Yeah, so interesting question, and maybe I'll sort of go back to college for 1 second here, just to talk a little bit about it. I interned at Schonfeld after my sophomore year in college, and that was a great experience. And then I got to like full time dedicate myself toward seeing how the traders operated every day, all day throughout the course of the summer. Obviously, I developed certain relationships from my first internship work study program at Schonfeld in high school, but then just getting to be a part of the action, all summer long was really rewarding. And I thought, like, at that point I was pretty gung ho that I was just going to go to Schonfeld straight out of school. I developed relationships. I was doing all the things that sort of mentors in my life, had told me to do. And I was pretty set on that path. And then I had the opportunity to go study abroad, and through that study abroad experience, I had the chance to meet several other people who, through certain conversations with them, just shared with me the advice of like maybe I should go out and get a little bit more of a well-rounded perspective on how the business world operates, on how the markets operate before being sort of dead set in terms of going back to Schonfeld. And so I decided to apply for, summer internships, at some of the bulge bracket firms, in trading oriented roles. I was fortunate enough to land an internship at Goldman Sachs. And I decided that after my junior year in college, I was going to take that opportunity and then compare sort of that opportunity to the opportunity to work at Schonfeld and think through sort of what was a better path for me. I ultimately chose to go to Goldman, and I think that was a really good choice in that being a part of an internship class of, at that point, probably 300 individuals, and then a first-year analyst class of roughly the same, provided me this unique opportunity to, be part of an additional network that I think would be able to stick with me throughout the rest of my life. And as somebody who's kind of always focused on building networks or having sort of common experiences that you can then relate back to at different points in life, I think that was just an awesome opportunity. And many of the relationships I developed from that summer internship experience at Goldman and then working at Goldman throughout the first few years of after my college experience, were really, really leverageable throughout my experience now over the last 13 plus years, at Schonfeld. So if I said to you first and foremost, how did the Goldman experience prepare me, for Schonfeld, the number one thing I would point to first and foremost is relationship building. And relationship building such that, you had common ground or common experiences with said individuals that you could then rely on or relate back to throughout the course of your life. And frankly, my Duke experience has been, really the same. I'm here, recording today from Durham, North Carolina. And the reason why I'm here in Durham, North Carolina is really twofold. Number one, Duke had a basketball game last night against the University of Florida, which we won by 1 point. But, Duke is a special university because not only is it a great academic university, but the tie-in of Duke basketball brings people back to this common interest or this common ground throughout the course of one's life that sort of emboldens or embodies like this further sense of school spirit, further sense of the power of a network that's pretty unique for, a really, really well-rounded large academic institution. And so that's been another rewarding network in my life. Secondly, I'm here because I'm now on the board of the Duke Endowment. And through being on the board of the Duke Endowment, I now have an opportunity to develop an additional network of people who are in the investing world, who are running several other large investing organizations, who we gather together to help give advice to the Duke Endowment on how to deploy capital, how to think about risk management, how to manage the assets of the university to develop a consistent return stream, for the university over time. And so we unite over a common ground as it relates to how to do that. And I've had the opportunity to learn from this network in other ways that certainly helped my Schonfeld experience. So sort of the power of networks and developing networks would be the number one way in which sort of Goldman, helped prepare me, for my time at Schonfeld. Secondly, culture. I learned a lot about how or what a well-functioning culture looks like from my experience at Goldman. Goldman did an amazing job in terms of giving people an opportunity to be successful at a young age if one was able to deliver outcomes. And so they created this environment that helped propel, successful people to want to win, want to compete, and want to challenge oneself to be kind of the best version of themselves. And they did that by putting you side by side on the desk with other really, really smart people, all of whom wanted to continue to figure out how to win, but do it in an environment where you were united behind, common outcomes or common objectives. And so while each of us were responsible for running risk or running books, in different sectors or in different industry groups, like we were there together to maximize the P&L of the desk that we were working on. And so, working in the credit business, we were there to maximize the credit P&L of the Goldman Sachs trading desk, albeit we were each responsible for a different set of names or a different set of credits to do that. And so I think like being on that in that trading desk environment, having that will to win, having that will to compete, having that will to be the best version of myself, I think certainly helped for me create an environment that I knew that I wanted to take, to Schonfeld if I eventually found myself, in a more leadership oriented position. Third, thing that I would take away from my Goldman experience is the notion that like crisis and or challenges are the best learning opportunities. And so I got lucky. I got thrown into a situation, at Goldman where early on was the GFC or the financial crisis. And so stress levels were high, anxiety was high, risk was high, and we had to navigate through that. And so at such a young age, being exposed, to what many would describe as maybe a once in a decade or once in a multi-decade type experience, to really learn through crisis, certainly helped me think about, how to develop skill sets that would ultimately be able to, again, be leveraged upon as we navigate crises, here at Schonfeld. And then the last lesson that I would say I took from the Goldman experience was sort of the opportunity to escalate risk or the opportunity to speak up, when you felt like you needed to share a perspective that might not be being easily surfaced amongst a group of people for ABC, or XYZ reason. And so I was presented with an opportunity to speak up, and or challenge, one of the things in which somebody I was working for was doing, and it was a difficult thing to do because I was directly reporting, to that individual. But by speaking up and escalating a risk that I saw developing in a book, to other people in the organization, I was presented with a lot of praise and a lot of endorsement as it relates to having the courage, to challenge the norm, to speak up, to present information, in a way that ultimately would help the organization make the best long-term decision. And I think from that experience, I took, to Schonfeld, the notion that we needed to create a culture at the organization where people were given the form to be able to share their perspectives and speak up, whether you were the most junior person at the organization, a mid-level person at the organization, or a senior person at the organization, because by having that type of environment, we are going to long-term make the best decisions as an organization.
And Goldman's famously this meritocracy, as are a couple other banks Bear Stearns used to be, or like even some in Brazil like Garantia. But I'm interested in these two aspects that really interest me is kind of your love and passion for statistics, and then also what you described as like network building. I'm interested in how you kind of parlayed those into becoming CIO at Schoenfeld at age 27, and ultimately at age 29, you convinced one of the greatest traders of all time to take outside capital. Tell me about a little bit about how that became possible at 27, and then ultimately what that was like at 29, being able to convince and what it made kind of went into the making that decision.
Sure. So actually, the two things you mentioned are ultimately what convinced Stephen to give me the opportunity to become the CIO. I think the leveraging of statistics, analytics, and insights, to help identify patterns was something that I had an opportunity to showcase to Stephen, at a young age. And then secondly, by doing that and then continuing to develop that relationship with Stephen from that early experience allowed me throughout my Goldman days to maintain that type of connectivity, to ultimately be given an opportunity to come into Schonfeld and help shape the future of the organization as Stephen was looking to evolve his role in the organization. And so throughout my time period at Goldman, Stephen and I would go out for dinner once a quarter, if not more frequently, and I would share my perspectives on what was going on the credit desk at Goldman. What was I learning about Goldman Sachs that I thought the Schonfeld organization could incorporate into its organization as it was developing its business. And so I gave Stephen some great ideas as it relates to the importance of leveraging data, technology, analytics, building a best-in-class platform, how to create competitive edge, and not only create, but then be able to sustain competitive edge in certain areas. As you're building a business, how to identify areas to create moats around some of the revenue streams, that you're building. And I thought we did that uniquely at Goldman Sachs because of the strength of our strat organization and the strength of our technology as compared to some of the other banks, throughout the course of the financial crisis. I'll share one story with you. During the GFC, in the days before Lehman ultimately filed for bankruptcy, we were brought into the trading desk on a weekend to have a weekend session where we, alongside many of the other bulge bracket banks, would conduct a weekend trading session that would allow us to do certain trades such that if Lehman were to file for bankruptcy by XYZ time, these trades would go into effect such that we would have reduced counterparty risk, to Lehman on our credit default swap portfolio throughout, in the aftermath of Lehman filing for bankruptcy. And what was particularly unique about the setup at Goldman Sachs during that trading session is we understood our risk and the way in which our risk would shift if in the end of the day Lehman filed for bankruptcy in a way that was so dramatically different than the way in which any other bank understood its risk. And that gave us as a trading desk a significant competitive edge, not just during that weekend trading session, but in the aftermath of Lehman filing for bankruptcy, to be able to price risk, and identify opportunity in a very meaningful way that allowed us to have an unbelievable trading quarter in the fourth quarter of 2008 and even into the first quarter of 2009, in a way where many of the other banks spent a lot of the time just trying to figure out the risk because they hadn't invested the time, effort, and resource in developing the right systems, developing the right processes, to be able to visibly see risk and stress test how risk may change if certain scenarios play out. And so, we at Schonfeld, frankly, even before I got there, tried to identify, what it meant to have best-in-class technology and systems in some of the asset classes that we wanted to trade or wanted to be invested in. And so I think that through sharing some of those experiences with Stephen and by ultimately sharing with Stephen that where my passion lies is not just in investing, but the combination of building a business and investing, that ultimately sort of created the opportunity for Stephen to take a chance on me, to be a part of the next generation of leadership at Schonfeld. So that was kind of the convincing of Stephen to bring me in, as CIO of the organization. As it relates to the second part of your question on sort of convincing him to take third-party capital, that was much more nuanced and a much more challenging and difficult conversation. But I think ultimately the convincing arguments became the opportunity to do at a larger scale across a more meaningful pool of capital what we were doing for him and his family, for the last several years, and frankly, even for the years, before I joined the organization. And why was it important to do it at sort of larger scale? One, that would give us the opportunity to have more capital to invest in the technology, infrastructure, and data to be able to maintain a competitive edge on a go-forward basis. Two, we would be able to build a better portfolio by investing some of that capital in building out infrastructure overseas to be able to port some of the strategies we were investing in the U.S. Into some overseas markets. And so, in the aftermath of taking third-party capital, we expanded into Asia, into Europe, and certainly over the last few years, into many different emerging markets, investing in some of the strategies, that have been a part of our portfolio in the U.S. For quite a while. And then lastly, the strategy was really about how through time could we attract, develop, and retain the best talent. And the view was that talented risk takers ultimately want to challenge themselves by having the opportunity to manage larger pools of capital and do it in a way in which they could responsibly grow each of their businesses. And while the Schonfeld family had significant capital to invest, we ultimately had a view that having third-party capital in the business would give us the opportunity to attract better talent and ultimately retain better talent in the organization. And sitting here, roughly a decade, almost to the month from when we took in our first third-party capital, I would say that each of those three parameters has largely played out in the way in which we expected it to play out roughly a decade ago. What's been different, I would say, has been just the scale of the infrastructure that we've built over the course of the decade to support going from what was a family office managing the assets of a single family to today, running roughly a $17 billion hedge fund, that's investing across many different global markets across lots of different asset classes. And so we joked around at the time that, by bringing in third-party capital, we'd probably need, maybe 3 or 4 additional people in the organization. And I would say what we got wrong was that, we underestimated that by several hundreds.
Before we go back to the episode, I want to take a short break to talk about my sponsor, Row. The Generating Alpha podcast is presented by Row, the all-in-one banking platform for startups. Thousands of startups like Perplexity, Product Hunt, and more use Row. You get everything you need to manage your startup's cash. Fast banking setup, cards with up to 2% cashback, and yield that turns company cash into extra runway. All super important in the early days of launching. But the thing founders really love about Row is their team. They're obsessed with helping founders disrupt the status quo and will go to the end of the earth to help them to do so. And exclusively for Generating Alpha podcast listeners and viewers, you'll get a $1,500 statement credit plus a ton of exclusive perks when you manage your company cash with Row. Terms and conditions apply. To learn more, visit rho.co/generatingalpha. Row is a fintech, not a bank. Checking and card services provided by Webster Bank. Member FDIC. See reward terms for details. Thank you, and back to the episode. You spoke about this idea of pattern recognition and then also statistical edge to an extent. But I'm also interested I've interviewed a lot of the better traders in the world in this podcast and been able to spend some time with some incredible people. And there's a lot of people that can pattern recognize or can dive really deep into kind of the analytics. But the best traders, I mean, at least what I've observed, sets apart the best traders is kind of anecdotal insight and the ability to really express their views and also kind of use the insights that they get, consume a lot of information, and use that in their trading. So I'm interested in what you think kind of between those two factors makes a great trader, and then also how much of being a great trader is innate versus taught. Because for you, it seems somewhat innate in the sense of you've had that love for statistics very early. And it doesn't seem like for a lot of the best traders in the world that it's taught.
So I think there is some element of it being innate, and I think every trader is different. So I don't want to speak on behalf of many of the other great traders that you've spoken to, or certainly that exist out there. But having watched many traders develop at Schonfeld over the course of the 13 years that I've been at Schonfeld, I do think it's a combination of both. I think there is a certain element of how much raw skill set does an individual have, how much drive, ambition, and passion, do certain individuals have people throughout the course of their life demonstrated a consistent ability to win. And I do think that is a predictor of future success as a trader or as a portfolio manager managing a pool of capital. That said, I think there is many things that can be taught by having good mentors and by investing in good and repeatable process that I think can also meaningfully change the probabilities or the odds of one being able to experience long-term success, as a risk taker or as a portfolio manager. And I think as I have gone about building, our business, at Schonfeld, I start by trying to have consistent and repeatable processes that allow me, as you suggested, to process significant amounts of information rather quickly, and then be able to store that information, through my own brain, or through a team, that I rely on, to then help me make better long-term decisions. And so I think it's a combination of continuing to develop good process, good repeatable process, develop a team that can then help you be intellectually honest around that process and challenge you around the way in which you leverage that process, to make decisions, and then, also having, good raw innate abilities, to be able to see things one, two, three steps before, other people are able to identify those things.
And Schoenfeld's in a space with a lot of giants in a sense of the likes of Citadel, Millennium, Point 72, and even ones that have been growing relatively recently, like BAM, in which Dimitri came from Schoenfeld, despite having lower AUM than a lot of these larger competitors. I'm interested in how you describe what it takes to win in this industry.
Sure. So, look, all great firms, and I won't comment specifically on any of them, but all of them have talented leaders, and all of them, have developed over multiple decades, a great ability to figure out, how to win. Quite similarly to what we've been able to do at Schoenfeld. I think it starts with number one, being able to attract great people into the organization. Number two, at least for me, being humble enough to recognize, what you do well, but also, where are the areas that you need to complement yourself with really, really strong people that can help create leverage and help create scale for you to continue to be able to focus on the areas, that you do well. I think three, being unemotional about the way in which you make decisions. It is quite easy to get caught up in the passion of what we do. That said, I think good decision making comes from an ability to distance yourself from an emotional perspective relative to what the data analytics and or intuition is kind of pointing you in a certain direction. And I think that's a third way that each of the leaders you identified through time has been able to develop into winning cultures and winning organizations. And then lastly, I think it takes navigating through challenges, and being able to develop resilience through having a team that has had lived experience navigating through a variety of different experiences that ultimately really can refine the way in which you go about making good long-term decisions. And so for me as an individual, as I touched on earlier, the financial crisis helped shape my early experiences as a trader, and as a risk manager. Then we had the European sovereign debt crisis, where I continued to sit on the credit desk at Goldman. And then certainly in getting to Schonfeld, there was the first quarter of 2016, which was sort of the first episode of kind of factor volatility, where many people became obsessed with how individual factors were driving volatility within individual portfolios. And then certainly there was the COVID pandemic, and having to navigate through some of the challenges associated with hopefully what will be a once in a century, if not even less frequent than that, type of health pandemic, and the havoc that wreaked on business and society. And then there was the GameStop challenges of 2021, and what it meant to have concentrated short portfolios, and how that could create risks, in within one's book. And then for Schonfeld, we've had our own individual and idiosyncratic challenges, that we've had to navigate. But I think challenge has presented opportunities, for us to become better as an organization, and ultimately for us to continue to develop, that winning culture that you identified.
And before moving on to a little bit of advice and one kind of question about insight, I'm interested in you mentioned attracting talent. And attracting talent is very hard in this multi-manager industry. But not only is attracting talent hard, retaining it on top of it is even harder. And you guys have consistently maintained one of like the lowest PM turnover kind of percentages in the industry for years. And you've also been loyal to the same firm you worked at as a teenager. I'm interested in what does loyalty mean to you, and how do you think about retaining the best talent in the industry?
Yeah. Look, it's this is going to sound simpler, than it should, but it's do the simple things right. If you do the simple things right, um, the ability to retain talent becomes significantly easier. Don't get me wrong; it's super competitive out there. Not just the firms you mentioned, but many, many more that
Yeah.
we compete with across, lots of the different strategies. We run a big quant trading business. We've got our own competitors that are quant specific firms. We've got a big macro business. There are many hedge funds that we compete with for talent that are macro dedicated. Then there are our multi-strat peers. Then we compete with the banks for talent. We compete now, in what is an AI dominated world with many, large cap tech companies as it relates to recruiting engineers, and other infrastructure personnel to help sort of drive our AI efforts forward. So it's highly, highly competitive. And so we depend upon, as an organization, doing the simple things right and creating a culture where people are proud, to wear the Schonfeld jersey. And so I repeat that frequently, that like we want to have, raving fans of our business, whether that be the most junior oriented individuals in the organization, or our leadership team. Like we want people to be, great brand ambassadors, because our brand ambassadors are ultimately what helps us attract the next generation of talent, into the organization. And then, to go back to one of the things you said, like our long-term talent retention strategy is our talent attraction strategy. And so through time, being able to retain talent has then, had a circuitous reference of being able to then attract talent to the organization, because we're the organization that people want to come to, not just to build a business, but hopefully to develop enterprise value throughout the course of their career.
And a little bit before you mentioned being able to kind of consume as much information as possible and process it. And I'm interested in kind of your life as the CEO of a large multi-manager. What does a day in your life look like in terms of information intake? Like when you wake up, what do you read? And like throughout the day, what's the kind of information flowing into your brain look like?
The first thing I do when I wake up is I say to myself, expect the unexpected. Because by putting myself in the right mental framework, and the right mindset, I think that allows me to adapt to, the many different curveballs that get thrown at me. Not just in my life as a CEO and CIO, but I also have four young kids, at ages 9, 7, 5, and 3. And they throw many curveballs, at me as well, that I need to navigate and balance in the course of balancing my professional and personal life. So I think it starts with mindset. But then the second phase is, I wake up, we run a business that has 40 to 45% of our risk overseas, so the day has started well before my alarm clock goes off, in the morning. And so, I spend the first part of my day getting caught up on what's happened before, the sun has risen on the East Coast. And that's a combination of what's happened at Schonfeld as well as what's happened in markets. I then try to, again, continue to, emphasize my mindset. So I do work out most mornings, at some ungodly hour, to be able to put myself in the right mental mindset to navigate, the day's challenges. And then I get to the office, relatively early, because I'm an early riser and I'm certainly a morning person. And I want to be prepared for the day at hand. And so, I've spent considerable amount of time reviewing for any meeting that I've had. I've had the team that works for me, anchored by a great, chief of staff, prepare me for my meetings such that I walk into any meeting. And whether it's with, again, a senior leader at Schonfeld, a team of mid-level or junior people at Schonfeld, or many different folks that I navigate, with or communicate with, externally. And I want to be the most prepared person in that meeting. And so I want everybody in that meeting to know that I have properly prepared for that meeting. I'm ready, because by being ready and being a good example, hopefully I can perpetuate, what I think being prepared for a meeting looks like, for everyone else that's attending that meeting. And so I think by me being prepared, I create a good example for many other people across the organization. But again, back to sort of that early quote, like the day will throw many curveballs at me. The market will throw many curveballs at me. And so I've got sort of my best laid plans, but then I need to prepare to get punched in the face. And when you get punched in the face, you then need to be able to react and respond appropriately. And so I think I've gotten better at it through time. I'm far from perfect, as it relates to it, but we've gotten better, and I've gotten better, at being able to shift rather quickly, where my time is going to be spent at the course of, over the course of any given day.
I love that. Expect the unexpected. And before I move on to the question I ask every guest at the end of every episode, I'm interested in I was recently listening to this podcast. I don't know if you heard of Invest Like the Best, but he was interviewing Steve Mandel from Lone Pine. And
Yep.
Steve said that in this, I think it was in the 70s or 80s when he was at Goldman, you could call the SEC and get quarterly reports before anyone else just by calling them. And that's all to make the point that information over time has become so much more accessible. And kind of data and research are increasingly commoditized, and they have been over the past decades. So I'm interested to that point, what do you see as the new frontier of edge?
Yeah, I think actually being able to effectively um, differentiate or separate what is signal versus what is noise, I think is critically important, and where in the end of the day we develop edge, and hopefully we can sustain edge, or will sustain edge, through time. As you said, there is so much data and so much information that is being thrown at us consistently. I think having a really good process for being able to identify what data matters and what data doesn't is critical. And obviously, leveraging AI or many other different techniques, I think, can give people important and critical ways of being able to go about doing that, be able to create more efficiency from a process perspective. I mean, we've got tons of people today that used to spend a lot of time organizing data that now, in the end of the day, if programmed effectively, can be done in a fraction of the time. And so we need to, and I need to, continue to invest in ways to become more efficient as it relates to how to separate signal from noise.
And I want to finish off on the last question I ask every guest. I'm 16 years old right now. If you were to give one piece of advice to a 16-year-old today, it can be career advice, life advice, social advice, and this one always cracks people up, but even romantic advice, what would it be?
Go to Duke. It's the best combination of a well-rounded academic experience with a great social experience, and where, again, personally biased, the power of the network is amongst the strongest out there, and certainly for me has been incredibly valuable throughout the course of my personal and professional life.
Well, it was great to have you on, Ryan. Really appreciate it. And thanks for taking the time.
I promised you I'd pitch you Duke at some point, so there you go.
All
All right, thanks a
right.
million.